Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden within those dense corporate filings. Today we are diving into a report that details how a certain fund is paying out it is. Investors, will it be a windfall or a trickle? Let's find out. Alright, so what we have here is what is called a Form 8K filing. Think of it as a very important announcement from a company to the public. This particular report is about T. Rowe Price Select Private Credit Fund, and it is giving us an update on their distributions and financial standing as of the 25th of November 2025. The key date here is the 25th of November 2025. This is when the events described in this report happened, or at least when the company decided to report them. It tells us the company is giving out money to its shareholders. Now, the company itself is called T. Rowe Price Select Private Credit Fund. That sounds a bit fancy, but put simply, it is a fund that invests in private credit. What does that mean? Instead of loaning money to big public companies whose stocks you can buy on the stock market, this fund loans money to private companies, ones that are not publicly traded. This can sometimes offer higher returns, but also comes with higher risk. The fund is based in Delaware. That is not super exciting, but it is a standard piece of information included in these reports. This section called Regulation FD is really about keeping things fair. It means if a company shares important information, it has to make sure everyone gets to hear it at the same time. They can't just tell one investor and not the others. So here is the juicy part, the distributions. Basically, the fund is paying out money to its investors. They are calling them regular and variable supplemental distributions. Regular distributions are pretty standard, like a normal paycheck. Variable supplemental distributions are extra payments that can change based on how well the fund is doing. Then we see these different classes of shares: Class I, Class S, and Class D. Think of these as different types of membership in the fund, each with its own rules or benefits, which can affect how much money you get. Let's look at the numbers. For Class I shares, investors are getting a regular distribution of 20 cents per share and an extra variable supplemental distribution of 3 cents per share. That totals 23 cents for Class S shares. It is also 20 cents regular, but the shareholder servicing and distribution fee takes a bite, reducing the net regular distribution to around 18 cents. Then add the 3 cent variable supplemental distribution, bringing the total to about 21 cents. Class D shares have a similar regular distribution of 20 cents, but this time the fee is smaller at about half a cent. This leaves a net regular distribution of almost 19.5 cents. Add the 3 cent variable supplemental distribution, and you get a total of about 22.5 cents. These payments are expected to go out around the 30th of December, and they go to shareholders who own the shares on the 28th of November. So if you were a shareholder on that record date, you are getting paid. You also have the option to reinvest these distributions, meaning instead of getting cash, you can automatically use that money to buy more shares in the fund. It's like letting your earnings work for you right away. Moving on to the next section, which talks about other events. This is where we get some important updates on the fund's overall health. First up, net asset value, or NAV. This is basically the total value of everything the fund owns minus any debts it has. It is like the net worth of the fund per share. As of the 31st of October 2025, the NAV per share for all classes was $26.88. This is a key number to track the underlying value of your investment. Looking at the bigger picture on the 31st of October, the fund's total net worth was a massive $1.51 billion. They had investments worth almost $2.75 billion. Now, they also have debt, which is money they borrow to invest, and that debt was about $1.28 billion. This gives them a debt to equity ratio of about 0.85 times. What does that mean in simple terms? For every dollar of equity or net worth the fund has, it owes about 85 cents. This isn't excessively high, but it does mean they are using borrowed money to boost their returns, which also amplifies potential losses. Next is the status of offering. This tells us how the fund is raising money. The company is continuously selling shares to investors up to a total of $2.5 billion. This is called the offering, and they sell shares monthly. The table here shows how many shares they have sold and for how much money. For Class I shares, they have issued over 46 million shares, bringing in over $1.28 billion. Class S shares are much fewer at about 4.2 million shares, raising just over $116 million. And Class D shares have seen about 5.5 million shares issued for around $150 million. So Class I is clearly the most popular and brings in the most money for the fund. They continue to sell shares of these different classes. Now let's talk about what this all means. T. Rowe Price Select Private Credit Fund is actively managing its investments and distributing profits to its shareholders. The distributions are modest but consistent with a regular payout of 20 cents across the board. The variable supplemental distributions add a little extra something based on performance. The fund has a significant amount of assets under management with its NAV hitting over $1 billion. It is using leverage, meaning borrowed money, to enhance returns, which is a double-edged sword. It can supercharge gains when investments do well, but it also increases the risk if investments falter. As of October, their debt level seems manageable, but it is something to always keep an eye on, especially in private credit where companies might be more vulnerable during economic downturns. The continuous offering means they are actively trying to grow the fund by bringing in new investor money. This suggests confidence from the management team that they can deploy this capital effectively. However, for investors, it means their stake might get diluted by new shares being issued unless the fund's underlying assets grow proportionally. Looking at the NAV, per share of $26.88 makes sense when compared to the total value of assets and liabilities. The total value of investments is considerably higher than the NAV, meaning the company has significant debt. The debt to equity of 0.85 is not alarming, but it does signal a risk appetite. In conclusion, the T. Rowe Price OHA Select Private Credit Fund is operating as expected by providing regular income through distributions and growing its asset base. The main risks here lie in the inherent nature of private credit investments, which can be less transparent and more sensitive to economic shifts than public markets. Also, the use of leverage means that while upside is amplified, downside risk is too. What is your take on these numbers? Do you think the fund's strategy is sound, or are there red flags you are seeing? Let us know in the comments below. If you found this breakdown useful, please give this video a thumbs up and subscribe for more corporate filings decoded. And hey, don't forget to join our Discord community linked in the description below. We have some great discussions happening there. Thanks for watching. See you next time.